This is the Opal Dividends Podcast. My name is Jay Coulter, and joining me, as always, is Adam Muller and new father Austin Graff. Austin, Jaden Carter Graff was born just last week. How has your first week as a father been?
Oh, it's great. Plenty of sleep and plenty of time to myself. So everything's great. It's great to be a father.
Good. It only gets easier from here. You're already past the hard part, trust me.
I'm sure.
Let's start with the popular bull and bear segment. NVIDIA, Adam, let's start with you. Bull or bear?
I'm a short-term bear, long-term bull on NVIDIA. I think to me, as someone with a value bent, it feels like the AI boom was a little bit overhyped. The stock has run a lot. It's trading at a big multiple. So they'll have to execute and things will have to go very, very well to justify that over time. But over a longer time frame, say 5 to 10 years, I do think AI is a very important driver of growth, and NVIDIA is one of the best positioned companies to take advantage of that.
Austin, Disney's been in the news a lot the last 6 months.
From a short-term perspective, they're obviously struggling quite a bit. So I'm a bit bearish in the short term, but I think over time, they're going to get some things turned around. There's a lot of value in the Disney franchise. However, they need to operationally fix some issues at Disney. So I think it's cheap. It's probably cheap for a reason in the short term, but longer term, as they fix operations and get margins back in shape, get some of their media properties producing appropriately, I think that it's going to be a good long-term hold for investors.
Adam, Apple has been in the news here recently. What's your take today, bull or bear?
I'm a bear on Apple. Yeah. And I just think that over the Apple's had a tremendous run in the stock this year. It's been a safe haven for people to hide as they figured out what they really wanted to do. But at 30 times earnings, it's quite expensive for a company that doesn't have a lot of embedded growth with products that are so mature and generate so much free cash flow. But there's an argument around how much that's going to grow over time. So Apple, if I owned it, I wouldn't necessarily sell it, but I wouldn't be a buyer at these valuations.
Austin, JP Morgan, bull or bear?
Similar perspective to Adam. We've owned it. We reduced it recently. So I guess that's somewhat bearish, but long-term bullish for JP Morgan. It's one of the best banking franchises in the world. Definitely the best banking franchise in the U.S. However, the issues they're having in the short term is management's coming across saying that they're over-earning right now. Essentially, they're generating too high of revenues on their asset portfolio, and they're not paying enough on their liability portfolio as those liabilities kind of increase in price, and the assets might see some degradation due to some write-offs and whatnot. If we have issues with the economy, you could see earnings come down, and the current valuation that looks really attractive might not be so attractive as we move through this current economic cycle.
Adam, bull or bear on Verizon?
I am a raging bull on Verizon. Look, I think Verizon and AT&T as well, we can lump that in, have been left for dead by the market, when in reality, these are great companies that generate a lot of free cash flow that are coming to the end of a huge CapEx cycle that will result in even more free cash flow. And Verizon at 7 times earnings with an 8% dividend yield, it almost seems too good to be true, but I just think that sentiment is that poor. But I would be backing up the truck on Verizon.
Austin, UPS is in the news this month. Bull or bear?
I'm a bear on UPS. I mean, $170,000 for truck drivers just seems a little excessive. It shows that the workers are kind of getting the upper hand on management. At the same time, we're seeing volumes come down for the business. So they're seeing kind of a double whammy of higher costs, lower revenues that are really eating into margins. We don't think the current valuation accommodates for that. We wait for the valuation to come in further before entering a position.
Adam, bull or bear on Paramount Global?
Paramount Global. Look, Buffett owns it, and he can't be wrong. Look, I think I'm going to have to say that I'm a bear on Paramount Global. I think that no one really knows what to do or how to value these streaming companies right now. For years, it was based on the number of subscribers And then that sort of blew up in everyone's faces, and they've been cutting costs. Their Paramount is over levered. They had to cut the dividend this year, which saw the stock get killed. And it's not clear to me what the strategy is going forward, or how you turn the streaming business into a profitable, cash flow generative business. That said, the out is consolidation, and maybe that's the reason Berkshire owns it.
Austin, Johnson & Johnson, bull or bear?
I'm a bull on Johnson & Johnson. There's a couple things going in their favor right now. One, they're spinning off the Kenvue business. Well, actually, it was spun off earlier this year. Now they're selling down their stake, which should be a good thing for J&J. They're also making progress on talc liability exposure. I know that hasn't been the most positive thing in the headlines or in the news, but that's created an opportunity for long-term investors to get into a high-quality pharma name that has potential to grow into the future as some of these issues are kind of put behind them.
Adam, let's wrap up with Qualcomm, bull or bear?
I'm a bull on Qualcomm, but I will admit that, and I was a bull before this recent quarter, which was a difficult quarter for them. Qualcomm, has a big business in let's call it non-Apple handset chips, and there's that segment is struggling, but it feels like it'll turn soon. Microprocessors are such an important growth story over the next 5 to 10 years, and Qualcomm is an integral piece of that puzzle. So for 12 times earnings, it seems like a great time to get into Qualcomm.
12 times depressed earnings because they're at the wrong part of a cycle in a cyclical business. It seems like a great time to be in Qualcomm.
Excellent. I love the bull and bear round. Nice, quick, to the point. Let's go a little bit deeper on some of the bigger topics today that investors should be thinking about. Fitch recently downgraded the U.S. Credit rating for our debt. Austin, how do you look at that as a portfolio manager?
Honestly, we don't really care that much. I think it made headlines, and there were some billionaires out there that were talking about whether it be short-term ownership of T-bills or owning 30-year debt. The yield curve is inverted, so 30-year debt looks expensive while T-bills look relatively attractively priced. At the end of the day, it kind of impacts the cost of capital when we're valuing companies. But Adam and I have adjusted our cost of capital 18, 24 months ago as we saw interest rates increasing. We think the market hasn't necessarily adjusted to the point that the risk is currently indicating. So we were kind of there before Fitch stepped up and downgraded the treasury.
Adam, any additional thoughts on how investors?
Yeah, the only thing I'd tack onto that is when we've just gone through a rate hiking cycle that not only was one of the largest in terms of the amount of the increase in rates, but also one of the quickest in history. So from a government standpoint, the government's interest burden increases significantly, which puts pressure on fiscal spending. So this Moody's downgrade sort of felt like something that most investors, if not all, had already downgraded the U.S. in their own thought process, and this was just sort of acknowledging it. This felt very different than the downgrade in, I think, 2011, when you had another debt ceiling issue, and you had the European sovereign debt crisis and fears of contagion, and that really sparked a huge sell-off in the equity markets. This was like, oh yeah, we already know that. Move on.
Speaking of sell-offs, the regional banks sold off at the beginning of the year when they came under duress because of a couple of failures. Just recently here, Moody's has come out and downgraded some of the regional banks. How do you guys look at that as it relates to exposure in a portfolio?
Just in general, I feel like the rating agencies for the debt rating agencies are behind the curve, right? This issue popped up literally months ago. We made adjustments to the portfolio. We had seen some of this stuff coming because we saw the duration mismatch in a number of regional bank portfolios, and that started to flow through equity prices. It's kind of surprising that people still pay for these ratings when they come out a quarter and a half after the issues have become obvious in the headlines. And so if anyone's making changes based on some Moody's report that says that there's a mismatch in regional bank balance sheets, I don't think they should be investing, right? Like, I don't think people should be giving their money to them, or they should be getting paid to invest on behalf of others if they're so lazy they're waiting for the rating agencies to tell them what to do.
So this still has an impact on the regional banks, along with the duration challenges that they have to be experiencing today. Has it improved at all since the beginning of the year, or why have we not heard of more duress recently?
It's because of stock prices. It's literally a sentiment-driven game. The issue still exists at many regional banks where they've essentially borrowed short-term through deposits at extremely low rates. They haven't raised deposit rates with treasuries, and so money's flowing out. While they had to lend, they had to do something with those deposits. They put them in long-term assets. So regional banking is typically a borrow short, lend long business. If you look at the yield curve right now, you've got a T-bill, and this goes back to the Warren Buffett, Bill Ackman argument, where the 30-year is yielding 1% less than the 3-month, right? And so if you're borrowing and you're paying out, you're paying over 1% more than what you're earning on your assets. That's a bad business for anyone, and the regional banks are stuck in that place. I think when you really boil down to the issue, people talk about an inverted yield curve leading to a recession, and I think people they use it as more of a talking point than really thinking through what's going on in the economy. The reason an inverted yield curve leads to a recession is because it locks up the credit market with the regional banks, who are no longer willing to lend to mom and pop businesses because of this dynamic where they're borrowing at a higher cost than what they can lend at. And therefore, there's no more money flowing through the economy to support economic growth. And it's taken longer for that to happen than we would have expected, because the Fed was shouting from the rooftops to anyone that would listen that they were going to raise rates at an absurd pace for the last 18 months. So if there are companies out there that haven't refinanced and fixed out their financing costs for the next 10, 15, 20 years, they were either lazy or they couldn't. And either of those companies are not companies that you want to be owning in your equity portfolio.
So, Adam, I can't believe it, but we're about to get into another election cycle. We're
Can
recording
I just add
this.
something to the Moody's thing?
Sure.
And Austin alluded to this, but it's August, and the regional bank crisis really flared up in March. Like, what's Moody's going to announce tomorrow? Another slew of downgrades because of the Great Depression? It's ridiculous. You know what? I'm going to downgrade Moody's for waiting so long to downgrade the regional bank's debt. You can't just look at what the market does and then impute rate downgrades. No one cares. You know what doesn't matter anymore? Moody's. Sorry.
Excellent. That was worth it, Adam. That was worth it. Let's talk about politics. We're recording this at the end of the summer of 2023. I can't believe we're about to get into another election cycle. Republican primaries are coming up. There may or may not be a Democratic primary. It's going to be all over the news. How should portfolio managers and investors look at politics when building a portfolio?
Look, I would say certainly at this stage, I would say to largely ignore it. There's headline risk and rhetoric. And once the campaigns really heat up, of course, all the candidates will be asked about their economic policies, and they'll all say outrageous things that sound great to certain groups of people that are actually impossible to execute or to turn into law. So as a portfolio manager, look through that, think long-term, and manage a portfolio as you would in any other year. That would be my advice at present. Now, when it gets down to the actual, when we know who the candidates are and things heat up a little bit more, heading into the actual, November vote, then maybe if it looks like it's going one way or another, maybe around the edges, there's things to think about. But making major changes simply based on who you think is going to win in general, I think is a bad idea.
Yeah, making portfolio changes on campaign promises is like playing roulette. There's no way of actually handicapping that appropriately. And unfortunately, many portfolio managers tend to invest with their own political tilt, expecting, their preferred outcome to reign the day, and that causes them to make poor decisions in portfolios. The way I think about it is, when it comes to politics, wait until the bill is signed into law, figure out who the winners and losers are, and invest accordingly.
Yeah, I'd also say subjectively that financial advisors tend to build portfolios with political leanings in a lot more dramatic way, and it's more prevalent in the advisor community, which never leads to good outcomes.
Right.
All right, so this question is for both of you. So we've really seen a sentiment change around an inevitable recession that should have started already, to now the base case being a soft landing. Each, what's your take today? How are you viewing it?
Well, I can start if you want, Austin. I think that as Austin and I have talked about this particular question probably at least once a week, if not more. But it's not a question that really leads to huge portfolio changes. And I don't think that this change in sentiment, the market's change from a recession is inevitable to soft landing is now the base case, really changes how we think about the portfolio. I think if you have strong companies that are growing through the cycle, that pay a good dividend, that are good allocators of capital, that are going to grow that dividend over time, you'll be fine regardless of whether you actually have a recession. And look, there's different kinds of recession. You could have a technical recession, 2 consecutive quarters of negative GDP growth. One economist will call it a recession, then the other one will call it a soft landing, and they're both probably right. So some of this is just sort of semantics. But in any event, I don't think it's had a huge impact on how we've thought about the portfolio.
Yeah, there's a couple things that I would just add to that. Is one, I'm not really sitting here saying like, ooh, when are we going to get a technical recession? Which I think when everyone thinks of a recession, they think of like 2008, 2009, or they think about 2020, which were really very dramatic downturns in economic activity. A typical recession is not going to be the bottom falling out of the economy where everything just gets crushed. It's going to be, things are slowing, and people don't really agree that a recession's starting. And then by the time everyone agrees that a recession started, the market kind of adjusts because we're pretty much through it. And so it puts us in a unique situation where we don't really care about the recession, but we care about how investors are positioning capital based on their expectations of a recession or no recession. So some of the abnormalities we see in the market right now is, if people truly believe that there's going to be a soft landing, or there's not going to be a hard landing for that case, there's not going to be a recession, then the yield curve is out of whack, right? The Fed's not going to reduce rates without some type of economic pain flowing through the system. Right? So if you have to have economic pain to flow through the system to get lower rates, economic pain will likely wear on company fundamentals, which means many of the companies that are leading the index right now are overpriced. And so we think investors should factor in the point that like interest rates either need to come up or we're going to have some type of economic pain when you're thinking about allocating your portfolios.
Adam, we're wrapping up earnings season. One of the great fraudulent shell games of all time, in my humble opinion, is for a company to come out and say, we're going to do 7 cents, and they come out and they magically beat it by doing 9 cents. How are you looking at this earnings season?
I think it's even crazier than that this earnings season, where someone says they say they're going to do 7, they hit 9, but last year they did 12, and they still get rewarded for 9. It's this idea of this sort of, people getting so mesmerized by these analyst estimates in companies, whether they beat them, or miss them, versus what is the actual trajectory over the last few quarters, last few years, and what does that lead you to believe about the next few quarters and next few years? So in this very strange scenario right now, where a lot of companies seem to have beat estimates but are shrinking year over year. So unless you think a turn is near on a company by company basis, it's not. You need to look deeper than just did they beat or not beat the estimates. But there's a lot of smoke and mirrors that go on with these earnings announcements, and I think the entire U.S. economy would be better off if we went to semi-annual earnings. But that's a different topic.
It's so easy to manipulate short-term earnings. If you really want to dig in to understand what value is being created at a business, look at the balance sheet. The balance sheet's more stable. It's going to show you long-term value creation. It'll help you understand why the things that are happening are actually happening, instead of just looking at some EPS number, which is completely like most management teams manipulate the heck out of earnings. Focus on free cash flow, focus on what's going on with the balance sheet, focus on how retained earnings are expanding, and that'll tell you what your long-term expectations should be as a shareholder in that company.
Austin, there's been some noise about inflation reaccelerating and then conflicting noise about it decelerating. When you look at gasoline prices today, you look at healthcare costs, clearly accelerating. Maybe there's some areas of the economy where it is not accelerating anymore, but I haven't found them. How are you looking at inflation today?
Yeah, it's a great kind of issue right now. I don't think inflation's going back to 2% anytime soon. There are just so many issues. I mean, we talked about UPS, where you're seeing double-digit increases in wages, and they're not the only ones. You're looking at airline pilots that are getting 40-50% increases in wages over the next few years. There are a number of contracts where unions are holding out right now. You even have a writer's strike in Hollywood, right? So it's not just kind of blue-collar workers. It's blue-collar, white-collar. It's all workers are trying to get their fair share. And we think that's going to lead to kind of more of a push on inflation than what I would say is kind of a pull from kind of supply chain issues. We're seeing kind of in the travel space, people they seem to have more money, or I'm not really sure what the driver is of the massive demand for travel. Maybe it's just when you put people in their houses for multiple years and they feel like they missed out, they just have to get back on the road regardless of if they have the money or not. But it does seem like we're kind of seeing this rolling demand that's continuing to push inflation. You got oil prices that are back up over $80 in the U.S., driving gasoline prices. That's a big driver. I just don't think it's going anywhere anytime soon. So investors should prepare to live in an environment of above 2% inflation.
Well, and we learned this week that credit card debt for the first time hit $1 trillion with 8% delinquencies, and that has to have an impact in there. Adam, let's finish with really what's probably the most important question of the day. What do you do when you own a stock and the company CEO challenges the other CEO to a cage match?
Yeah, so let's just talk about what we're really talking about here. Elon Musk and Mark Zuckerberg have challenged each other to some sort of cage match. And here's the thing. We all know that Elon Musk is like a quirky individual. So it's not surprising that he would do something like this. But if you're Mark Zuckerberg, you're a founder CEO. You had a really tough year 2 years ago. You had to cut costs, fire people for the first time. You still want to be you still need some credibility as a CEO, and you're actually entertaining the idea of this cage match. And good for you that you work out and that you do jujitsu. Good for you, Mark Zuckerberg. But the fact that you're entertaining this and allowing this to continue, if I was on the board of directors of Meta, I would tell you to stop it.
Do you think the walrus is going to be effective?
The walrus
on Zuckerberg. You didn't see that? Oh, Elon said that he has a trademark move of the walrus.
Of course.
Where he sits on his opponent.
Hey, is there a chance that this is just a distraction from the fact that Threads had a magnificent launch and fell completely off a cliff?
Look, I think Threads. I don't know if Threads is dead yet. I think the launch was inevitably going to be huge because anyone with an Instagram account could click a couple buttons and have a Threads account. So, and then a bunch of those people weren't really going to engage once they'd done that, and that's what we've seen happen. The question now is, as they add more functionality to Threads, what happens to it? Well, at the same time, Elon Musk woke up one day and decided to change Twitter to X, which can't wait for the Harvard business school case on how dumb that was. But I don't know. It's an interesting time in social media and media in general. And my takeaway from all this is no one really knows what to do, and they're all throwing spaghetti at the wall and floundering, trying to figure it out. And it'll be very interesting to see how it plays out. But because of Threads' connection to Instagram and Facebook, I imagine it's here to stay.
Well, I'm pretty sure that Opal Dividends podcast viewers would like to know if there was an internal cage match at Opal between the two of you. How would that pan out?
Well, I have a signature copyrighted move, but I don't want to tell Austin what it is in case I ever have to do it.
I think I have youth on my side.
That's fair.
All right. Viewers, thanks for tuning in to this edition of the Opal Dividends podcast. Remember, go to opalinvest.com to learn more about Opal Capital.
The viewer of this content should not assume that any information presented or made available on or through this media channel is receipt of or substitute for personalized investment advice. Opal Capital, LLC is an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or expertise. Opal provides its services exclusively to registered investment advisors, either through a sub-advisor relationship or a model provider consulting arrangement. For a copy of Opal's disclosure documents, please visit advisorinfo.sec.gov and follow the search instructions. Visit opalinvest.com or opaldividendsdigest.com to learn more.